All right, well, AVID investors, it's time for the AVID market update. Let's talk about what's the general climate of the real estate market today in a nutshell. We have some pent-up demand. Winter brings a lull, and we do see buyers flirting and moving about and a little bit excited to start seeing inventory on the market and buying again. Yet they are still requesting negotiations, and sellers are still conceding on some negotiations, showing it's not an absolute crazy market in either direction for buyers or for sellers. For investment purchases, more buyer motivation is required because today's lower return on investment, the lower ROI, just doesn't give them as much of a return on their investment, largely due to interest rates having climbed. That super affects the cash flow. And overall, cap rates are up a little bit from where they were when interest was lower and we had the frenzy of buying around, like, say, 2022. Is there still room for cap rates to increase further? I don't know. It was predicted that they'd climb a little, and here they are. So TBD if they go up a little bit or not. But keep in mind, cap rates are your return on investment without any debt service included. So those are going to be a trend that does not get impacted by the interest rate, whereas your return on your investment does. That's the market in a nutshell. Of course, speaking of interest rates, not yet speaking of interest rates, we did have that economic forum last month, and we talked about it. Yes. I believe so, yes. We talked about it last month, but we had a economic guy, Ted Jones, came and gave a presentation. And this was the most noteworthy slide that I wanted to save and repeat just this one time. Jobs and housing are in balance. As you know, this market, as you know, if you've looked out a window in Boise, building is happening. But also we have a lot of jobs coming at Micron, a lot of job growth there. So it's neither a seller's market because of all the people, all the jobs and job seekers and the people who need housing to fill those jobs, nor is it a buyer's market because we do have indeed the inventory balancing that out. So no runaway advantages. The cost of living is a competitive edge in Idaho. Migration still favors Idaho. While we do have more people leaving than were for a while, our gain is a net gain population-wise. Homeowners are staying put longer. Well, this happens as things get more expensive and as interest rates go up, there's less nimble opportunity to move. And the big takeaway that I heard is don't bank on cheap money soon. So I think that the interest rates are not going to drastically go back to where they were several years ago. Of course, they're based on that US 10-year Treasury yield, and we're seeing that it's up a little bit. Interest rates are up a little bit from where they were last month when we spoke. In fact, here's exactly what they look like. If you're in the market for a loan, single family home, 30-year fixed rate, owner occupier, we're back into the low sixes. Last month, I would have been saying high fives. High five, high five. Multifamily is around in the mid sixes, and if you're putting 40% down, you can get a more compelling interest rate. Not cheap money anymore. So, and then for some of you, I mean, I think that creates an opportunity. If anybody here has paid off assets, paid off properties, when you do decide to sell, being the bank isn't the worst idea. You could always consider an owner carry loan and screen someone really well. And there's some pitfalls that can happen with that, as some of us know, but there's always pitfalls that can happen. And so that's something we're seeing some investors looking at. The rates, now that the rates would pay for that. And the toilet leak, not your problem when you're just the bank. The banker doesn't have to come out with the toilet or answer the plunger or answer the phone on a Thanksgiving. But anyway, I'll get my vocals out of the toilet and present Danielle Costa from Swope Investment Properties and the Boise Investment Properties team to present on the residential single family homes. Thank you, Danielle.
Thank you, of course. Canyon County is next, which is my bread and butter. But let me go over Ada County first, which is probably where a lot of you invest in. Just a little tidbit of information. I was seeing that CUNA is renting really well. We had more applications on a CUNA house than some of my Great Meridian and Boise locations. So just something to consider if you're looking at investing in single family homes, maybe take a peek at CUNA. So with the median sales price in Ada County, we're at $538,000. Everything was up last month. Median price was down from the last year a little bit, but now we're seeing it back up again. Year over year, home sold houses are up. Wow, cannot talk. That's why I'm drinking coffee at 6 p.m. It's been a Wednesday. 60 days on market, so we're seeing that up as well. And then inventory is also up in Ada County. Obviously I dug into Canyon County a little bit more. So we are seeing that the median sales price is up at $441,000. What is really driving that is new construction. So resale homes, the median was at 405, but new homes were at 462,000. So there is quite a bit of a price gap between new and resale, which I was surprised by how big that gap was. Out of the 362 homes sold, while that is down, 184 of those were new construction. And a lot of the decrease, new construction is affecting that on homes sold. It was a higher percentage of less new homes sold. We have inventory is down. You can see more than half of it was new construction in Canyon County. And then we also have 63 days on market. That is up. So I think there's just a lot of homes being built there. And that is where we're seeing days on market higher. It's also affecting the inventory quite a bit in Canyon County. I am going to pass the baton over to Jocelyn, who specializes in our short-term rentals.
Thank you. Hi, everyone. I noticed that over these past couple months, I have been giving you guys short-term rental updates and sub-market scoring and didn't really break down kind of what that means. So I have that here today to give you a little bit of background. I am the owner and operator of a short-term rental property management company here in the Valley called Capital City Comforts. And so this is what we do. This snippet of the Nampa submarket and how it performs is kind of just a small bite-sized example of what we present to our homeowners when they're looking to see if a short-term rental is right for them. So we subscribe to quite a couple softwares that allow us to compile all of this data. And you'll see on the next slide how Nampa is scored in a submarket for performance. And these are some of the things that are taken into consider for that. So a big software that we use and subscribe to get a lot of this data is called AirDNA. And if you're in the short-term rental industry, you probably have heard that name before. The information that's presented here is compiled largely from Airbnb and VRBO. And the metrics that kind of drive how your market scores is based on the investability, so the ROI potential, the rental demand, so the occupancy and bookings, revenue growth, which is year-over-year trends, seasonality, so the income stability, and then the regulation with legal risk. So just basically how short-term rental friendly that area is. So each submarket is scored across all 5 of those metrics to combine into one score. And then it's only taking in consideration like in the US. So kind of keep that in mind as I go through this. Oh, wrong way. Okay. So this is the Nampa snapshot. So it scores 88 and the lowest you can go is 40. So it's from 40 to 100, it's out at 88. So that means it's in the top 12% for performance across the country, which is actually pretty incredible. It surprised me myself. What that is a representation of, again, is those 5 metrics. So if we break that down, you have your average daily rate. So this is for Nampa as a whole. We can break it down based off of homes, neighborhoods, amenities, and all of that. But as a whole, your average daily rate there is going to be $140 per night. Your annual revenue is going to be $30,258. And how you get that for like your individual property is looking at your occupancy rate times the annual revenue to kind of see what the potential for that property has. This breaks down what is a part of that sub market as far as rentals go. So 32% is 1 bedrooms, 2%, or excuse me, 20% is 2 bedroom, 28% is 3, 13% is 4 bedrooms, and then 7% is 5+ bedrooms, which 7% for 5+ bedrooms is actually a decent amount. And if you go on like Airbnb, VRBO, anything like that, and you look at these bigger properties, it's actually pretty incredible. People are renting out like 15,000 square foot homes with pickleball courts and all these different amenities. And so and all of that's kind of, a lot of that's in that area. So I think that's why you see that up a little bit than what you would see in like the North End or Boise. And then this is the rental growth over the last 3 years. And the occupancy over the last 3 years as well. So we're this is 2026, this blue line. So we're kind of trending up like what we saw in 2025. And everything is up. The annual revenue's up, daily rates up, occupancy's up. So Nampa's looking like a pretty good spot right now to have a short-term rental, kind of depending on where you are. So that's the Nampa overview.
Any questions on the short-term rental market for Jocelyn on Nampa or beyond?
I'm just thinking, it's 30,000 gross income, but what about all the expenses? So what's the net? So what's the purpose? How much does it yield to the owner?
That's a good question. And that's why I kind of started with this is a very overhead view of what we present to our homeowners in a meeting, because those overhead costs and your mortgage, all of that looks a little bit different for everyone. So short-term rentals are very unique in the way where overall for Nampa, it could be great, but for individual properties specifically, the returns could maybe be much better somewhere else versus the other, versus maybe when they bought, what their mortgage is, what their insurance is. So that is something that's important to take into account, is that annual revenue wouldn't be accounting for any of your current expenses.
So you didn't name utility costs, energy costs, or the cleaning every time there's a turnover.
Yeah, and cleaning.
If you're paying for a mortgage, that's not much left.
Yeah, absolutely. And that's why it kind of differs from property to property. Good point that you brought up with the cleaning. Luckily, what's nice within the short-term rental industry is bookies pay for that themselves. So when you go on Airbnb, you pick where you're going to stay, you have your price per night, your taxes, and then your cleaning fee. So that is nice. That is a cost that the owners don't take on. The people who book the properties pay for that. But there are, and even, Wi-Fi is one as well. A lot of people expect to be in Airbnbs with Wi-Fi. So that's why it's important it's great to get a bird's eye view, but it's important to, if you're considering it, to sit down and say, what are my expenses? What could the revenue be? And does this make sense for me?
We used to see a 0.5% difference in cap rates. So you get a little boost in your overall bottom line after all the extra expenses because the income was more, but it wasn't necessarily enough what I found is there should be a second reason to be short-term renting it. Or it should be a place like a studio where the furnishing costs are low and you don't have yard care, say. Someone else is doing yard care. Or like for a while we were sharing the internet with our little ADU, where you can reduce costs, but we did it to get the garage because it was a studio above the garage and there was no yard for it. And they shared internet with the house. And so, but then we got the garage. But I mean, if anyone, what we should do, Jocelyn, and you guys can ask us for this or hold us to this, is we should take one of your properties that anonymize it, or if the owner would let us, and run a year-end what it did last year, Because we could certainly predict what those numbers would have looked like on a long-term rental.
Mhm.
And so we could compare side by side how that bottom line looks for that property.
Yeah, absolutely. I
And
think
anyone
we could do that.
considering it.
Yeah.
We could do that, you know.
That's a great
Did I
idea.
see a hand up anywhere here?
So what is going on in Napa that you have that much of a demand for short-term rentals?
That's a good question. I think it's a
Up
little,
there.
I think it's a little bit of it all. I mean, you have the hospital out there, right? You have the Ford Idaho Center. You have a lot of people who have moved here over the past couple of years from out of the state that just need a place for their family to stay. So I think it's kind of all encompassing a little bit of it all.
And it's newer, they've got all the new build out there. And you saw that difference in the median price of single families. So I don't know how many people you have are Airbnb kind of near where they want to buy a house once they settle in or anything, but I mean, there's a lot of people buying in Nampa now. For
I
the
have-
price difference.
One that I have seen it used for personally is there's a lot more wedding venues out in Nampa.
Oh, yeah.
So families will try and be by the wedding venues and stay in Airbnb homes in Nampa.
Yeah. That's
So
a big
people are
difference.
used to coming from larger cities where that little commute time is not.
Yeah. And maybe they don't want to be in the city, they'd rather be out in the country somewhere. Or on a 15,000 square foot compound with a pickleball court. So,
Girlfriend, you're very young to have your own company. Congratulations.
thank you, thank you. I appreciate that. It's been 2 years and I can't take all of the credit. I have an amazing partner in business and in life, my fiance Dylan. I am all operations. He is all numbers. He has multiple degrees in finance. I could never take on that. So
Well, good
we
choice.
work well together.
Yeah.
Yeah, right? Thank you, thank
that
you. Awesome. Anyone else?
She's also the newest agent at Swope Investment Properties, but just really crushing it. Just really a true asset, like we're partnered on a deal and her and Danielle have been doing deals. Danielle's been showing her the ropes, but I mean, yeah, it's by no means a newbie, especially with this property management experience.
Yeah, and before this, I did door-to-door sales for 10 years, so never been scared of a little hard work, because that's difficult. So, but thank you for the praise and for that. So I'm around, obviously, if you guys have any questions, let me know, and thanks for having me.
All right. Thank you, Jocelyn. That was super. Back to duplexes and fourplexes and some data. What's going on in the multifamily market? Because a lot of us in the room I know have some multifamily interest or properties. Inventory's down to 30 from 34. So it's down a little bit from last month. Of course, we're looking at February's data because there's a little bit of delay in time to compile it. And so it was down from January. Pending deals was steady. And then sales had increased from 2 to 10. And absorptions at a very moderate, comfortable place at 3 months, above 3 months for fourplexes and around 2 for duplexes. Nothing super crazy off kilter. And Tony Drost has been running the numbers on Ada County fourplexes for a long time, a decade or more. And so we have data, and watch the 6-month trailing average as the most important indicator. Because when you have a month like last month where there was only one sale, that can really skew your data. So as much as we'll look at that sale, it was a very, very large, newer fourplex. And so the price per square foot goes down when the size goes up. And so what do we see? Well, we're going to look at the 6-month trailing average. 4.75% is the steady 6-month trailing average on a cap rate. So that means if someone pays cash for their property, they're getting about a 4.75 return on their investment, minus before, what do you call them, capital expenses. So that's your expectable expenses, your utilities, your steady expenses, and what is a capital expense and what's not is up to debate. Maybe if it's a super duper tree trim that costs you thousands versus like a tree trimming that you should expect to do kind of once a year, that could be a capital expense. And as we all know, capital expenses happen. So low margins, the gross rent multiplier is the rent to purchase price ratio. It's the down and dirty, quick and easy way. If you were wondering what your property was worth, you just take those rents and multiply them by the GRM, and bam, you have a rough price. So the February sale posted at a 170 gross rent multiplier. For an investor, the lower the number, the better. And the trailing 6-month average is 165. Days on market, 38, expected to trend slightly up. Average rent per square foot, because again, that rent price per square foot on the larger units is going to be lower. So it was only $1 a square foot in rent on that fourplex that sold in February, but average is a little closer to $1.45. And then, of course, price, it depends on age and condition and all of that. And so we expect that we'll slowly get back to like around a $900,000 average for a fourplex, but that February sale being newer did indeed spike the data. So if you look at the red line, that's the 6-month trailing average. Question?
This is probably something I can just Google later, but can you explain the difference between absorption and days on market?
Hardly. And I should be able to. So that's a really good question that I can hardly answer, but I can. Well, days on market's easy. It's just how many days it's active on market. Absorption is how long it would take for the market to absorb all of the current fourplexes right now. So if we needed to sell, if nothing else changed, it'd take us 3 months to sell all those fourplexes currently on the market. But in reality, everything changes. One goes away, one comes back. Oh, I did it.
Yeah,
That's it. It's a freaking number. Okay, so the red line is the 6-month trailing average. So you can see on those cap rates where they've gone. And so when we look back in 2022, you can see how low the cap rates were. Prices were higher, but rents have gone up since 2022, and the cap rate's gone up as well. So higher rents will help the cap rate go up. Lower prices will help the cap rate go up. Lower purchase and sale prices. And I like this. I don't know if that blue line is not a 6-month trailing average. It's just a random line, but you can see the average price of fourplexes there. And so last month was a bit of an outlier, as happens, but you can see before that it was really kind of steady and around that 900,000 mark that Tony expects it to get back to. The gross rent multiplier trend, that's a nice clean data point, nice easy data point to watch. And so you can see how for a while in the 2021, when like we ran out of houses, everything was so frenetic and crazy and exhausting. You can see how the gross rent multiplier went much higher. So people were buying things with a lower return on investment, basically. And now it's kind of tamed out a little bit. And for example, a 100 gross rent multiplier would be around that 1% rule, if you've heard of that, you know. Ada County fourplexes, rent price per square foot. You can see the trend line there. And I thought that would be a good one to include today. I don't always include the same ones, but especially since we're going to be looking at rent, affordability, I assume, because those things are also going to contribute to evictions. And so we can see right here a trend line on what the rent price per square foot is. And we all remember, everyone in this room, every one of you remembers when that little spike and some of those spikes were happening where you're just like, what's going on? Rents are going up just a lot all of a sudden. And then there was a little bit of a backlash from that, and then a kind of a stabilization. And then here's the price per square foot of actual fourplex. Okay, so here's what's active right now. It's a longer list than we're oftentimes seeing in Ada. And the one, what was interesting? Brogan's never interesting to me. What was interesting? Oh, there's a couple on Fortune Lane in that neighborhood. I like that neighborhood. They're nice floor plans. The tenants actually pay their own water there, so that's one less expense the landlord has to deal with. What really stood out to me was Canyon County. In fact, if I had a 1031 exchange money to spend right now, this is what I would buy, I think. Well, I've only glanced at it, but if you're looking for fourplexes, send me on research mission for those with that price drop. They did that one thing. You know that one thing we talked about earlier? Price it aggressively at the start, but then just, everyone ignores you, and then you end up going a little lower, maybe even than you would have expected to. These guys are old news. They have high days on market. They started out at almost $1 million, and it's a newer fourplex. It's only a 2022 fourplex. And so there was probably some substantiation of data for that, but nobody bought them. And I think there's only 6 in the community. They're 2-bedroom, 1-bath, no, 2 2s and 2 1.5s. And it's 9 upper 9s and then like upper 9, like 950 and 993 square feet. And the rents are decent. So I think these right now are worthy of a second look. If you guys have anyone looking for fourplexes, or yes,
This is the Martinez property.
Martinez.
Last month you talked about 6 units in Napa.
Mm-mm.
They were available, one was sold.
Right, nope, this is a totally separate deal.
That's total, okay.
Mm-hmm, yep.
Yeah, that one's.
Oh, that's Lucy Rose.
I just ran rents on those because I had an investor looking, and I think there is a little bit of wiggle room for growth with the rent as well.
What's the decent rent? What are the rents?
2
They were like in the 1450 range.
14, yeah, 14, 1500. A little bit of room.
So there was 1475 on one, 1425 on one,
Yeah,
and
one of them
sounds
was
like Danielle sees a little.
1435, 1400, 1400, 1350.
These are good prices for the rentals.
So they
Mhm.
definitely go up a little bit.
Yeah, yeah. So that's what I'm saying. I'm like flagging this one, you guys. We're gonna see it. It's probably not gonna last too much longer. 2-bedroom, 2-bath, or 1.5 bath. In Nampa. Not right by the freeway, but they have great freeway access. Kind of by airport, by the Idaho Center exit, like yeah, 2022. Closed management, I believe. I have an email into the owner or the listing agent. Do you know?
I don't know, but I can.
The listings wording was a little weird.
Yeah.
But it said like current owner has to subscribe to the current property manager. And so I asked, do all of the buildings in the complex have to subscribe? So it may be closed management. We've discussed it before. There's pros and cons to closed management. The obvious con is that you don't get to pick your own manager. If you have a manager you're loyal to, you don't get to bring them. Now in this, if you buy 3 of them, and Danielle, do you know if there's really only 6 in the whole community? So you're 50% right there. So you need one friend, and you can change that manager company if you review the CC&Rs and find that I'm not speaking myth right now. But usually that's what it would take, only one friend. And so when you're a big player in the sandbox like that, if you don't like the management company, you can put pressure. The other con against closed management would be lack of performance pressure potentially, or they may, not prioritize your unit if there's another one. But these are fully leased. Maybe there's a vacancy here or there, but this stood out to me with that age because capital expenses are lower on newer properties.
I can bring something kind of funny up with closed management and how I've seen somebody get around it recently is put it as a contingency. We're only gonna purchase it if XYZ% manages it. And
Okay. Well, and so I would argue they're going against the CC&Rs, so that's complicated stuff. But it worked, is what you're saying. It worked. Someone bulldozed it. Okay. All right. Well, it sounds like someone's broken through that barrier. Warning on counting on that, but certainly we'd be willing to help you try to, because we also like little freedom in who we use for a manager. So, but do be mindful. Like if it's in the CC&Rs and you're signing off on the CC&Rs at closing, like hopefully that owner, who knows if that, I don't know. Tell me more later. Okay. And this is the picture of it. I was so excited. This is the picture backdrop, and here it is in full. Look at that. It looks clean. No carports, just uncovered parking, and tenants value carports. But they've got the rents, so And then we also know that commercial properties greater than 4 units are a little bit more rare. Idaho has a lot more fourplexes than your average place, but this is what we have going on in 4+. The one that was interesting to me is also the backdrop of this slide, and it's newer. And the price per unit on this, I can't remember any of the specs. They just like literally drained out of my brain, but maybe it was a fairly decent price per unit. Nice that it was brand new. Of course, brand new means 0% occupancy. So they should be giving you a better price on it. But I liked the looks of it. It's over off of Vista.
So that's right across the street from one of our short-term rentals. And I was watching them go up, and I'll have to, maybe this has changed since it's officially listed. Last I checked, it wasn't. But I don't think they're finished on the inside. I think that it's maybe drywall in there.
And
So-
not going to be finished?
Not that I know of. I think that the builder ran out of money and they have to sell.
Well, that would be a reason that I'd be excited about the price point of a new build. It's okay, it's a partially new build, so,
Yeah.
but
and-
I hear motivation in that.
Yeah, maybe fact check me on that. I
thank you.
haven't peeked at what it is today, but one of the guys who I manage for is a builder. And he had his eye on them because he could obviously finish them and, pretty fast and turn it around,
Mhm.
so.
Well,
that's
it's
the last I heard on-
9 units for 2.5 million. And they are fairly, how many, do you remember how many bedrooms they have? Okay.
I think it was.
Mhm. Mm-hmm.
On this one,
Mm-hmm.
just at the mountains,
Yeah, just up a number, no. Maybe
4,000 square feet, probably. It's small for 9 units. Yeah, they're jammed down there.
Mm-hmm. Mm-hmm. Well, no, hold on.
I think we'll have-
No, because it's that building, 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 that building. So I think it's more than 4,000 square feet. Because there was one like that where I was like, oh, that looks good. And I'm like 400 square feet per unit. I'm like, never mind. But this one I think is actually, maybe they're even 3 bedrooms or something.
8 studios and 1 2-bedroom.
Oh, okay. Oh, and for 400 square feet, is this the one with the 400 square feet?
The 4,000, yeah.
Are the studios like 400 square feet?
Yes.
Okay,
Yep.
that was this one. Never mind.
I can't read, what's the address on this?
The address,
1910.
thank you. So what does first rate say? And Tom, this one is going to answer a lot of your questions as well. The first rate property management rental market recap says that renewals remain strong and consistent. I'm quoting Ryan. If you haven't worked with him in their operations team, he's great. Their renewal rate continues to land in their typical range, which is around the 70% renewals. 70% of their people are renewing every year. That's important because vacancy is the #1 expense. #1 numbers killer. And so it's showing that the residents are committed to staying if the conditions are correct. So they did do about 35 rent increases among the 96 renewals. So we'll just say roughly 60 people did not get a rent increase. Of the 35 who did, only 7 moved out. So they did not have a large move out or exodus when they did issue that rent increase. So that shows that even with the increases, the majority of residents were choosing to stay. I assume they were very artful in choosing which units, not artful, methodical and mathematical in which units got rent increases, probably those that were below market. And as soon as you give a rent increase to a tenant, of course, the first thing they do is hit the Zillow and the market and go, well, should I move? And so they're staying in line with their rents and in a way that people are saying, gosh, this is actually better than it would be if I moved. So the market is still strong and stabilizing. I assume they mean seasonally stabilizing. Residents who are staying slightly under are finding that moving is not cheaper, and it's certainly not worth the hassle. Moving itself is expensive, but they're not finding better rents elsewhere. So in general, the rental market characteristics right now feature stability, limited alternatives, which I find shocking, limited alternatives. But apparently limited alternatives, and a healthy and predictable renewal cycle. There just isn't a ton out there, they're saying, that's both cheaper and desirable enough to justify moving. And perhaps, and this is a question for first, right? But perhaps this is a symbol of what is being built now. Building costs so much, they're building these luxury places. And so perhaps the stuff coming on the market as new build is really going to be way more expensive than anything that's existing. Not to mention, people value stability, especially in the face of competitive pricing. So competitive rent prices, keeping your rent prices fair and competitive is key. It's going to keep your tenants staying and they're not moving out anyway, which is something we would see in a climate where rents were decreasing, because then anyone keeping up with market rents is lowering their rents. And so staying is going to it's going to cause an exodus. So the broader rental market right now supports stable rent growth with minimal resistance or move outs, so long as the rent increases are reasonable and they seem to be being well received, and tenant turnover as well.